Well, at this stage, I think the biggest threat is geopolitics, because we have seen what's happening in the East, and there, quite definitely, there the biggest threat is coming from. As you could imagine, only one boat sunk in the Gulf of Hormuz, and we may have a different oil price, and which of course may require us to rethink our strategy.
This event over the weekend comes just as we've had a whole bunch of data suggesting that some of the energy spikes that Europe contended with has been fading now from the inflation basket. So what would the worst case scenario be on first run effects, second run effects, if the geopolitics worsen? There are implications on oil and shipping. Well,
the most important is on energy. As I may recall, Europe is highly energy dependent. US is an exporter, so the US would profit. Europe again lose out of it. And then oil price going up there would be a major shock. But it's not the only one. The other one is, of course, then more disturbance about things sent out from Asia and arriving late and with higher prices in Europe, but also a second area of price increase.
I want to talk about European growth so far, because the IMF is calling growth of 0.8% this year, which is higher than the ECB's forecast, or March forecast was 0.6%. Is growth overtaking inflation now as a chief concern for the ECB?
Well, both are linked. Yes, definitely. Growth has been one of these concerns. It's a reason why, we act earlier before the Fed, because if you have and make growth, then of course the pressure on prices is low. In the US it's the contrary, so this is definitely the rise which may disturb us.
Earlier this year, you told my colleague Steve in Davos that there may be no cut at all for the ECB. Was that too hawkish?
No, this was built at a time when the growth prospects of the US and Europe were about the same. So I was hopeful at this time of higher growth, which would have also meant for Europe. And you see it from the US discussion, I was right. There may be no cut, but in Europe, the growth has substantially deteriorated. Also triggered a lot by what has happened in the Near East. And this is the one which drags down growth and which increases, the probability of raising or decreasing the interest rates.
While there's divergence in the growth story between the United States and Europe, economists point out there's not a lot of divergence on inflation, that with the calculations and the way it's based in the United States on owner's equivalent rent, it's really the calculations that's driving the divergence, not the actual rate. Do you agree that the inflation challenge is actually still similar between the US and Europe?
My take is that, yes, there is a difference. In the US, the most recent data has shown that the underlying core inflation is well above 3% in the United States. There in Europe it came down. So I think the inflation bases have departed because the growth bases are departing substantially.